I put this together last night and this morning. So I've taken the recent price cuts from Tesla and I've highlighted 4 different trims, the non-performance models, and I've pegged them against every other EV car maker in the United States just to kind of get an idea of where these prices stand. So I've pulled in the Tesla 3 and Y standard and long ranges, and then I've also pulled in Volkswagen, Ford, Hyundai, and Kia as well with their respective competitive EVs. And this is really focused mainly on what I deem to be cars that are within the same class as the Tesla products. So it doesn't include the Chevy Bolt because it's like 1 or 2 segments below and it catches fire all the time. So I feel like people can't even drive the damn thing, unfortunately. But this is what the pricing looks like in relation to the competition. So there's 2 things I want you guys to focus on. So this table is sort of from cheapest price after the EV tax credit if the car is eligible, all the way down to the most expensive. And then the last column is the dollar per range. So how much the car maker charges per mile of range you get from the battery. So 2 things stand out to me. Number 1, the Tesla Model 3 standard range after the EV tax credit is almost $35,000, which is what Tesla was trying to aim back in 2017 when they released the original Model 3. So 6 years later, you can still buy a Tesla for about $35,000, which I think says a lot. That, COVID, inflation, supply chain after 6 years. That's an interesting thing that has happened. Actually, there's 3 things now. The second thing is within the middle section there, you can see that the Tesla Model 3 and the Model Y, the Tesla Model 3 long range and the Model Y specs for the standard and long range, you can see that they're sort of stuck right there in the middle with the net price for the Tesla 3 long range, which is the second red bar, at $42,490 after the EV tax credit. And this is a vehicle that has all-wheel drive and 358 miles of range. And so why is this important? If you look at the last column, which is the dollar per range, I essentially divided, again, the net cost of the price to the customer divided by the range of the vehicle. $119 per mile of range. This is 10% less than the next best, which I believe is the Volkswagen ID4 long range, which is the third one there on the list. So from a cost competitive standpoint, it does seem like Tesla now has the cheapest per mile vehicle out there on the road within its class by far. And it has a very competitive offering versus everybody else sort of in the mid-range. And then if you notice, like towards the end, bottom of the list there, and this is like the huge discrepancy that has appeared because of this price change. The Ford Mach-E, the last one on the list, the long-range SUV. Don't get me wrong, great car. But there's 2 things going against it. Number 1, it's a $63,000 starting price for that SUV for all-wheel drive long-range vehicle, but it's above the $55,000 IRS tax credit sort of threshold for Ford because the Mustang is not an SUV; it's a sedan according to the IRS. God knows why. So now, if you compare the Ford Mach-E, the last thing on the list, to its direct competitor from Tesla, which is the Model Y long-range all-wheel drive, which is that one right there, there's almost a $20,000 delta between the Mach-E and the Model Y for like specs, right? And so this is a huge thing that has appeared because of this, and it's something to track. I would love to get y'all's reaction. We'll start with Richard, then Hans, then Kuba, and then we'll turn it into a conversation. And of course, in the comments, please let me know what you think about this whole thing. What are your thoughts? What's going through your mind?
Yeah. So in law school, what they teach you to do is they don't really teach you much of anything. They teach you how to research and they teach you how to issue spot. So I'm going to issue spot. So kind of the things that pop out to me, I'd be interested to see what the additional cost savings that might be incorporated that we're not aware of. When China indicated that was the reason for their price reduction, there may be some truth to actual cost savings. I'm also interested in seeing what happens to margins. How much are margins going to suffer, or are they going to suffer? If they don't suffer, then this is ridiculous, right? If margins don't go down, then let's just close up everybody else and let's just go home. If margins improve, then forget it. But I would expect some margin compression, some drop, just because the prices are dropping. I don't know what the new platform might bring in terms of additional cost savings, so that the prices can continue to drop, demand would continue to go up, and the margins would increase, which would be again phenomenal. I don't know how much the energy. We're talking about the mega packs. I don't know how much the margins in that business are going to supplement the margins in the car business, and we'll end up ultimately with the same 30%, but kind of in a different route, with the cars being at a much lower margin. I don't know what the competition's going to do. how are they going to compete when they can't make money on what they have now and the prices are going down? How does that work? I don't see. I think they're dead. I think they're dead in the water. In a recession, there are going to be a lot less cars sold, period. If they can't compete price-wise, and they certainly can't compete product-wise, really, that is a real death knell to a bunch of companies. And also, I think about BYD. We talked about BYD being in essence, the competition in terms of volume. With the price changes now, it'll be interesting to see if they're now on par, because it seemed like the economics in China drove a lot of buying decisions, irrespective of the product. And the other thing I was going to say is to keep in mind that the IRA, which every time somebody says it, I think of the Irish Republican Army. But when they say it, the IRS can change the rules. So even though, like the Indian indicated, the Mach-E is screwed right now, maybe after the IRS has a chance to reflect, there's a comment period, I guess. Maybe after they reflect, they might modify the regulations or the interpretations. So kind of those are what kind of popped out at me.
Yeah, I think that the Inflation Reduction Act is really the legacy bailout act, and especially after the actions that were taken by the IRS. I think that the Mach-E is kind of an unfortunate casualty of the desire to bail out GM and all the other, like Ford actually creating a somewhat viable full BEV puts the Mach-E in the same category as the Model Y, which they obviously did not want to subsidize for multiple reasons. First of all, Tesla doesn't need it. But second of all, the vast majority of this $7,500 tax credit, if the Model Y is eligible, is going to go to the Model Y. And so it increases the overall sticker price of that bill tremendously if Tesla is going to be ramping up to millions of, and we don't know what domestic sales will be of the Model Y prices like this, but definitely in the high hundreds of thousands per year. So that just balloons the overall cost of the IRA. And I don't think that was something that anybody wanted to sign up for. So they wanted the Model Y out. And then, unfortunately, the Mach-E, by being close to the Model Y, got out as well, because there was no way to create rules that kept the Mach-E in and the Model Y out. Well, now that Tesla's like, okay, here, take this middle finger. I'm going to put the Model Y under your $55,000 price cap. It's going to be eligible. We're going to flood the market with these vehicles. That leaves the Mach-E standing in a really, really bad spot. And it wouldn't honestly surprise me now if they end up classifying both the Model Y and the Mach-E as SUVs, because there's no point in keeping the Mach-E out in the cold at this stage of the game.
Yeah, maybe Tesla, they did it to spite the IRA or the government in general. Maybe they expected some foolish games to be played, and they had this as in their back pocket, or an ace in the sleeve, that they knew that they can lower to the cap that was known, right? So that would be an interesting development. And one thing I would also point out is that the price distribution among the models doesn't seem logical, because, for example, why wouldn't the Model Y long range be at $54,990? That's over 5% more that you could earn easily, and it wouldn't make any difference, basically. And the same possibly for the Model 3 Performance, because then people would choose whether they want 3 Performance, or if they want Y long range and qualify for the credits. And then the Y Performance could be way above the limit, and it's like 2K above the limit. It could be closer to 60K, and also a few more percentage points on the margins. So that's quite interesting.
That's a phenomenal point, and that's kind of where my head has been going with this. Is like, in a previous life before Tesla, I was in charge of really coming up with pricing strategies for a $1 billion company. And if I look at the Model Y long range at $52,999, I'm like, why the hell is it not $54,999? What are you guys doing? You're leaving $2,000 on the table. So I think that sends a message for those that are paying attention. I think one, Elon Musk has come out and very openly said that Tesla's goal is to advance the advent of sustainable transport. So how do we do that? By maximizing the affordability of the vehicles. Cool. So this is something that could very well fit within that realm. Will it impact margins? Obviously, right? If there's no mechanism on the backside that is allowing them to pass this on as savings to the customers, meaning since 2019, when the pricing was around this area before COVID and the whole debacle that we went through, theoretically in those 3-4 years, we would have had some sort of improvements in manufacturing, efficiency, supply chain, localization, raw materials, right? There's a lot of work that has gone in, and it's not like they're just sitting on their hands like this and chilling, right? Something has happened. Berlin has come online, Austin has come online, Shanghai's fully ramped, Fremont with Tom Zhu now is in there rejiggering the whole place and making it better, right? So this is cost savings somewhere that they're going to appear. So I wonder how much of this, and this is just speculation, and I'd love to maybe hear y'all's thoughts, because Richard kind of talked through this a little bit. How much of this is Tesla now being at a point where having these factories ready to essentially go full bore, they know they're going to be able to generate a certain amount of profit from these vehicles that they're comfortable with, somewhere, say, maybe in the 20 to 25% margin range. And now that full self-driving is coming towards software 11.3 is supposed to be released soon, plus Berlin and Austin going live, they're like, you know what? We're comfortable passing this on to the customer because we're confident by the end of the year, we're going to be back to where we need to be, where our investors want us to be, which is around 25-30%. And if that's the case, the implications from a financial perspective for this company are obviously great, but then everybody else is completely screwed. Completely screwed, because you've retained your pricing power by doing that, and you're already competitive with everybody else, because we know damn well that nobody's making money with these prices outside of Tesla. There's no way. There's absolutely no way. And they've been open about it. I mean, the Ford CEO has come out very openly and said, we're not making any money on the Mach-E. It's very hard to make an electric car at scale that's profitable. Surprise, right? So any thoughts there? I see, Hans, you're off mute. Maybe you get started and then we'll go from there.